What's up guys? Today I wanted to answer the question, is there a way to earn yield on your crypto without a lot of risk? And whenever I get that question, typically we want to look at like a more blue chip focused portfolio rather than an altcoin focused portfolio. If you guys are new here, my name is Richard. I'm a yield farmer and investor. I do help consult and manage a few 8-figure funds here in Asia. And this is one of my clients' portfolio. If you guys compare it with a lot of the other videos that I show you guys, this portfolio is mainly blue chip focused. You can see the major asset they're heavy in right now is Ethereum and USDC, as well as some Ethereum and Coinbase Bitcoin here on their yield farming pair. But to also make more cash flow and boost their returns, they are in some smaller cap altcoin pair as well. So this is closer to like a barbell strategy when it comes to yield farming and investing into crypto, which is what I want to go over in this video. But you can see this portfolio is very simple. Mainly it's Ethereum, some Bitcoin, some stable coins, and just a few altcoin positions to hopefully boost your returns. Overall, this portfolio has done pretty well. They entered the market last year when Ethereum was trading around 3,100 to 3,300. And you can see Ethereum is actually not that far off from that point, but they've been able to grow their portfolio from 150K to roughly now almost 210K. So over time, this type of portfolio could do really well if you know how to manage it and how to structure it properly. So before we dive into like the specific strategies, let's take a look at the overall breakdown of this type of portfolio. So if I draw like a pie chart here, this is kind of what you guys want to think of in terms of your overall portfolio. If you don't want to take too much risk, then more than 80% of your portfolio should be in blue chip assets and less than 20% should be in altcoins. And when I say altcoins, I'm excluding Ethereum here in this case, just because I believe that Bitcoin and Ethereum is going to be around for the next probably at the minimum 10 to 20 years. And you guys can decide for yourself which assets are blue chip, which assets are basically higher risk altcoins based on your personal research preference, and you can adjust the allocation as well. But the reason why we have such a big allocation to blue chip in this case is because we're valuing more stability and long-term growth rather than like explosive growth like 3 to 5x on our tokens when compared to altcoin heavy portfolios, right? And this is really great if you guys are really busy, you have a business to run, or you have to work like a job, then this type of portfolio is great because it could give you a lot of steady cash flow while the drawdown is not going to be as heavy as these altcoin pairs. And the really nice thing is, even though the portfolio might be volatile, you don't really have to worry about stuff like Ethereum and Bitcoin basically going to zero, right? Even if those assets drop really low, as long as the fundamentals are still solid, we actually want to be buying into our positions. So that's the first key idea here. We don't want to over allocate into altcoins if you guys want a lower risk portfolio. And within this blue chip portfolio, we could break it down into multiple components, right? We have our crypto to stable pools, stuff like Ethereum to USDC or wrap Bitcoin and USDC. And then we have our crypto to crypto pools. Those could be stuff like Ethereum to Bitcoin or even Solana paired with either Ethereum or Coinbase Bitcoin or wrap Bitcoin. And then we also have our HODL portfolio. And then the ratio you pick on this type of portfolio would depend on which strategy that you like, right? I personally like a wide range strategy because I could get a lot more capital appreciation. There's much less imparent loss, and then when the market dump is much less volatile. So because of that, my personal portfolio and my client portfolio typically have a heavier allocation to crypto to stable pools and crypto to crypto pools. I don't have too much of a HODL portfolio because with a wider range strategy, we could still capture the bulk of the move, the capital appreciation, and it actually gives us a pretty high net APR on the portfolio because we're able to put more assets into the crypto to stable and crypto to crypto pools, right? Sometimes you guys see those videos like saying, 100% APR, but the ranges are really tight. For example, for Ethereum, the current price is at 3,400 right now. But if your ranges is like from, let's say, 3,000 to 4,000, chances are you're going to be out of range all the time. If you rebalance up, that's not as bad if the market keeps trending up, right? But if the market draws down really hard, then you would suffer a ton of losses. And because of that reason, people that yield farm with tighter ranges typically have less allocation to liquidity pools, maybe 50% of their portfolio or less. So the net APR is not that high either, right? Let's say you have like 100% APR, but because you only put like 20% of your portfolio into liquidity pools, then the net APR on your portfolio actually drops down to 20%. So it depends on how you want to structure this, but the idea is we have these crypto to stable pools, crypto to crypto pools, as well as our HODL portfolio. And for the altcoin, we could do the same as well, crypto to crypto, and then our HODL portfolio. And just like the blue chip portfolio, you could pick like the different pairs you want to be in. For example, if you want to yield farm more meme coins, you could choose something like Bonk or MOG paired with either Ethereum or Solana, or stuff like Pendle and ETH, Aave and ETH, whatever asset you believe is going to go up in value like 6 to 12 months from now, or even 1 to 3 years from now, right? So these are definitely higher risk than just investing into Ethereum and Bitcoin. And then the crypto to stable pool could be anything like these, right? For example, just Bonk to USDC and so on and so forth. And a lot of times if you guys have like a heavy allocation to crypto pools already, we don't actually need a big HODL allocation. If you guys look at my client's portfolio, we actually don't have a lot of altcoin HODL bags because we're already exposed in this liquidity pool, right? If, for example, Clanker or Vader in this case goes up by a lot, then this pool would be converted to Ethereum. It's naturally going to sell out of those positions while earning a lot of fees in the process. If you guys look at transactions here, you can see this is actually being auto harvested using VFAT. These two positions you can see every couple of days spits out about 0.139, 0.13 ETH, right? And then over time these gains would add up, and it's just a really nice way to boost the profit of your portfolio if you guys have some altcoin pairs, right? Because a lot of times these blue chip assets, they're lower risk, but the reward is also lower, right? The APR is typically lower, so then that's why we introduced this 20% altcoin allocation. And the thing about this is even if this altcoin portfolio goes down by 50%, you still have this 80% of your portfolio that is in blue chip assets, so then your net drawdown would be much lower. Maybe those smaller cap goes down by 50%, but your blue chip asset only goes down by 25 to 30%. So the altcoins here would increase the risk, but also increase the reward. And really, if you guys want to grow your portfolio really quickly, we don't need a heavy altcoin allocation, right? Especially if you guys don't know how to pick good altcoins. Typically, you're taking on a lot of risk when you're yield farming altcoin pairs. So if your portfolio is like 100% altcoin pairs, especially stuff like meme coins, then it's very likely that you could lose a big portion of your portfolio if the altcoin market is not doing well. So the structure of this portfolio, again, I prefer a lot of the holding to be in crypto to crypto pools and crypto to stable pools, just because I could gain a higher net APR on my portfolio with wider ranges. But another way to structure this type of portfolio is to use some leverage with a lending and borrowing protocol. So what we're going to do in this case, if we want to leverage our portfolio, is we're going to prioritize this HODL portfolio. Let's say we put like the whole 80% into our HODL portfolio, right? We lend out stable coins if we want to go long in the market, and then we can deploy that into these crypto to crypto or crypto to stable pools. So let me draw that out for you guys to see. So on the lending side, we're lending stuff that we want to accumulate, right? Stuff like Wrap Bitcoin, Coinbase Bitcoin. Then we have our Ethereum and Solana, BNB, if you guys want to diversify beyond Ethereum on these higher cap tokens. And if we're bullish on the market, we believe that the prices are going to go up in the next 6 to 12 months. We could borrow against our assets here. So this is called a bull lever strategy. We borrow stuff like USDC or USDT, whatever you prefer. We take that and put it into LPs. And if the prices are kind of high and like in the middle of the range here, like the current Ethereum price, I typically don't want to go fully into crypto to crypto pairs, because if you guys are pairing crypto and crypto together, when the prices of the crypto drops, it tends to drop together, right? It doesn't matter what you pair. So if I enter here in a fresh pool of Ethereum to Bitcoin with the stablecoin, I'm essentially buying a lot of crypto up here, right? So if Ethereum and Bitcoin both draw down by 50%, then whatever asset I have in the LP would likely draw down by roughly the same amount as well. So since we're in the middle of the range here, what I would personally prefer is deploying into Ethereum to USDC or other crypto to stable pairs, right? So here we lend out, we borrow, and then we deploy into LPs, stuff like ETH to USDC or SOL to USDC. As long as these assets trend up over time, the LP value would go up and you're earning yield on top of that. So the borrow cost might be around like 6 to 10% APY, right? And depending on how wide your range is and how the volume is, the APR is roughly 30 to 50% for a more conservative range. If you guys go tighter, you could get higher than that, let's say like 100% APR, but typically that's a higher risk strategy. So with the fees that we generate, we could use those fees to basically pay back our loan if we want to decrease our risk, or we could accumulate more crypto and then add more collateral here on the left side. So it depends on what you guys want to do. But personally, I like to lower my risk if I already hold a lot of crypto and basically get rid of this loan over time, right? And what's really nice again, because if you guys have the altcoin LPs that we were talking about earlier, we could do the same thing, right? We could pay back this loan here that we borrowed against. So this is a little bit more complex. But the nice thing about this setup is because if Ethereum goes up really high, your Ethereum in this LP is going to be sold into stablecoin, right? We could pay back that loan at that point very easily, and we have full asset appreciation without any exposure to impermanent loss. So let's say you guys started with like 100K in our portfolio, and then we break it down to 20K into alts, right? And then 80K into blue chip. What we typically do is we don't want to loan out like the full value of the 80K. The liquidation point for a lot of these platforms is around 75 to 80% loan to value ratio. So because of that, we want to be a little bit more conservative. Let's say we borrow 30%. That's roughly 24K that we could deploy into our LPs. But again, because we're using leverage, and then we're also using only a portion of our portfolio that is in the leverage LP, we're getting a lower APR compared to putting a lot of your portfolio into the LPs directly, right? Because we're not earning on this 80K, we're only earning on this 24K. And again, depending on the risk you want to take, you could be looking at 30 to 50% APR or even higher than that. I could do the rough math for the yield here on the right side for you guys to see for this type of setup. So let's say it's the 24K you've deployed in the LPs. Let's say you're averaging about 50% APR on the 24K. Let's call the yield 12K. Then the yield from the blue chip LP is roughly 12K, right? But if you guys remember, we have this altcoin LPs. Depending on the risk you want to take and the volume, you could expect roughly 50 to 75% APR or even higher at like 100, 150% APR. But let's be a little bit conservative here and let's just say you get like a 70% APR. So 70% times 20K, that's roughly 14K, right? Then the net APR on your portfolio is roughly 26K. So this is not counting the borrowing costs and the lending interest that you're earning, because you're going to be earning interest on this, and while you're borrowing this, the APR could basically cancel out, right? So 26K on your 100K portfolio, if we just divide that, right, that's roughly 26% APR. Really rough math here, but this is a potential setup that you guys can consider if you want a lower risk strategy. And again, I want to highlight that you only want to apply this strategy if you believe the market is going to go up in the next 6 to 12 months or in the next 1 to 3 years, right? Because we're going long on these assets, if you guys borrow out too much, you do risk liquidation, right? Because whatever you lend out, if it drops in value by like 75%, you're at a risk of liquidation, especially if you guys don't have excess liquidity to back your loan. And the other setup that I talk about is a wider range strategy where we're earning lower APR on our pools, but we're putting more capital into the pools because we could generate enough fees to cover the impermanent loss if we stay in range for a long time. So in this case, let's break it down to crypto and crypto to stable pool, right? And then maybe the HODL or lending and borrowing that's earning some yield as well. So let's say you started with 100K. We could put some capital in this ETH to USDC and then maybe ETH to wrap Bitcoin. And these are just examples, right? You guys can structure your own portfolio based on what I show you guys and run your own numbers. Don't just hop into these pools without actually going through the whole process of planning your own portfolio. Because at the end of the day, the asset that we're bullish on and what we actually want to accumulate is going to be very different, right? So if I want to put 80% into blue chip, maybe I could put like 40K into ETH to USDC, and then another 40K here on this crypto to crypto pool. The benefit of the crypto to crypto pool is if the market goes up, you would not lose a lot of US dollar value as long as Bitcoin and Ethereum moves up, right? Because your crypto is not getting slowly converted to USDC on the way up. But again, the benefit of crypto to stable pool is if there's a big drawdown, your drawdown would be less. And then maybe we could have 20K in other alt to Ethereum pairs. And this could generate a lot of returns, right? The HODL could be 0 when you start, and then you could slowly use the fees to stack like ETH and Bitcoin as you earn more fees as well. Or you could reduce these allocation to, let's say, 30K here, 30K here, and then you put 20K into HODL. That's also a valid strategy. So we could run the math on the yield here a little bit. So for this ETH to wrap Bitcoin pair, for a more conservative range, you could expect anywhere from like 5 to 15%, depending on how tight and how wide you want to go, as well as the volume in the market. So if we're more conservative here, we could say it's 10%. So that's 4K, right? And then the alt and ETH pair, if we use the same comparison of 70% APR, that's 14K, right? For ETH and USDC, since we're putting more asset into crypto to stable pairs and we're running wider ranges, right? It could be around like 20 to 30% APR. We could just use 20% to be more conservative here. So if we earn 20% per year on our 40K, it would be around 8K worth of yield, right? If you total all that up, it's 26K. So also 26% APR, it just so happened to work out to be around the same, but the actual number could be different, but still 26% APR on your total portfolio is really solid. And I can write the APR here really quickly. 10% on this pair, alt ETH pair, let's say is 70%. And again, this is a conservative 20%. So very simple portfolio, 26% APR. You can't really get that with like traditional finance investment, right? And if you guys implement the strategies that I show you in other videos, then these pairs are typically much safer to yield farm with using a wide range strategy, especially if you guys are compounding and de-risking where you should and applying the strategies at the right time. So I hope that was helpful, guys. And before I hop off here, I just want to go over a few tips when it comes to this type of portfolio. The first one is if your portfolio is very small, you want to add your active income into this portfolio so that you could grow it over time, right? If your portfolio is only like 5 to 10K, these assets are likely to grow over time, but if you don't contribute active income into your portfolio, it's going to take a very long time, right? So if your portfolio is small, I really encourage putting more active income into this type of portfolio. But if your portfolio is already very large, what I would encourage you guys to do is to diversify into other asset classes. This could be anything from real estate, gold, and index funds that tracks like the S&P 500 and stuff like that. And this is basically going to decrease our market risk in crypto over time. I see a ton of people don't do this and then they end up with like less and less assets because they end up taking too much risk, which is my next point. If you guys don't want to take that much risk and you are a more passive investor, we want to try to stick with this type of allocation. If your altcoin portfolio, for example, starts off at 20% and then balloons to 50%, we want to make sure we're securing those profits and then shift a lot of those into blue chip assets. Don't get drawn in by the altcoin market, because sometimes the market is really bad. You don't really feel like the FOMO, right? You're comfortable in your blue chip. But then when altcoins are pulling like 5 to 10x's, it's very tempting to shift your allocation and then go from like 80 to 20 to maybe 50 to 50. And then you end up losing a lot of your altcoin gains because you're more passive. You don't really have an edge in that market, or the risk tolerance is just not suitable for you, right? A lot of times my positions sit in a loss for a very long time before I'm actually able to close for a profit, especially for altcoin pairs. So if you can't stomach those large losses, then we want to make sure that our altcoin portfolio doesn't balloon out of control. And the last tip I have for you guys is to focus on compound growth over time. Compound growth could be very, very powerful. Even just a 20 to 30% return per year is outperforming the benchmark and would grow your portfolio really quickly. Don't try to squeeze the range and chase like the high APR all the time. It's eventually going to come back and bite you. So just stick with your plan if you're more risk averse. You have to know yourself and be confident in your plan and keep at it for the long term, right? And if you guys enjoyed that video, be sure to check out the other videos on my channel as well. I try my best to give the most value in each of these videos. And if you guys don't want to miss out on new videos, then make sure you're subscribed as well. Thanks for watching. I'll catch you guys next time.